Have you ever found yourself wondering what the savviest investors do with their capital when the market gets choppy?
Yeah, where does the smart money go when things feel uncertain?
Exactly. Or, how a seemingly straightforward government IOU can actually offer profound insights into the entire economy.
Hmm.
Today, we're taking a deep dive into precisely that. Treasury bills, or T-bills, as they're commonly known.
Right. Simple name, but pretty important.
They might sound simple, yeah, but they're foundational to finance. And our goal for this deep dive is, well, to demystify what T-bills are, how they operate,
Why they're seen as such a bastion of safety.
and critically, the hidden signals they send about the broader economic landscape. By the end of our chat, you'll have a really clear understanding of these essential instruments.
And hopefully appreciate why they're, more than just a place to stash cash.
Okay, so let's start right at the beginning. At its core, what is a Treasury bill? Fundamentally, it represents a very short-term loan you make to the U.S. government.
That's the essence of it. Short term. To Uncle Sam.
Imagine, just for a moment, you're lending money to, well, one of the world's most reliable borrowers for just a few weeks, or maybe a few months.
Mm-hmm.
You purchase a T-bill, and in return, the government commits to paying you back a slightly larger fixed sum when that short period is over.
It's a beautifully simple transaction on the surface.
It really is, yet it underpins, a massive segment of global finance.
And that perceived safety.
Mm.
It's really one of their defining characteristics.
Why is it considered so safe?
Well, the underlying reason is the U.S. government's, frankly, impeccable credit standing. Historically, it's virtually unheard of for the U.S. government to default on its debts.
Okay, so reliability.
Exactly. That makes T-bills among the most secure investments available anywhere. It's not just a casual claim. It's really a globally recognized benchmark for what's considered risk-free.
Risk-free, that's a strong term in finance.
It is. So when institutions or individuals absolutely prioritize getting their principal back, T-bills are often, the first port of call.
That's certainty then. That's exactly why when you hear financial analysts talk about finding a safe place to park cash, they're very often referring to T-bills.
Mm-hmm. That's the phrase you hear.
It's not just about shielding your money from market drops. It's about putting it somewhere that offers an almost guaranteed return of your initial investment.
Even if the return itself is modest, the safety of the principal is key.
Right. The sheer reliability and security in preserving capital, that's what makes them so appealing, especially when things feel uncertain economically.
Definitely.
Now, let's get into the mechanics. Because how a T-bill actually works is a little different from, say, a regular savings account or bond interest. Our sources lay it out pretty clearly, step by step.
Yeah, the mechanism is unique.
The first step is that you buy a T-bill at what's called a discount.
A discount, so not face value.
Exactly. Let's use a concrete example to make it easy to follow. Imagine you pay, say, $950 for a T-bill. That's your initial outlay.
Okay, $950. Yeah.
Then, when the T-bill reaches its maturity date, maybe in 3 months, the government pays you the full face value. In our example, that would be $1,000.
Got it. Pay $950, get $1,000 back later.
Precisely.
Yeah.
And that difference, the $50 between what you paid and what you received, that's your profit. That's essentially the interest you earn, but it's baked right into that transaction.
Mm-hmm. That discount mechanism is, well, it's quite elegant in its simplicity, isn't it?
It is.
Unlike a traditional bond that might pay out interest, coupons every 6 months or so, with a T-bill, there are no periodic payments, none at all.
Just the one payment at the end?
Right. You just get that single lump sum at maturity.
Yep.
The interest is essentially embedded in that initial discounted price.
So you know up front exactly what you're getting back and when.
Exactly. It makes them incredibly straightforward for managing short-term cash. Reduces the admin for everyone involved, really.
It's very much like buying a store gift card for maybe $95 that you know is worth $100.
Good analogy.
You pay less up front, and then when you redeem it, you get the full stated value. That $5 difference is your gain. T-bills work on that exact same principle. Lend less, get back the full amount later.
Simple, predictable return.
Okay, so beyond this core discount mechanism, our sources highlight several key characteristics. And these really define T-bills and explain why they play such a unique role.
Yeah, these details matter.
The first defining feature is their maturity. Maturity just means when the T-bill pays you back its full face value.
The end date, basically.
Right. And we're talking really short-term commitments here. T-bills can mature in as little as 4 weeks, 13 weeks, 26 weeks, or a maximum of 52 weeks. A year.
No multi-year T-bills, that's bond territory.
Exactly.
And these short maturities are absolutely crucial. especially for quick cash management. Think about large corporations or financial institutions.
They have near-term cash needs.
Precisely. Payroll next month, maybe payment due in 6 months.
Mm.
These short durations let them match their investments to those known liabilities.
Ah, so they know the cash will be there when they need it.
Exactly. Ensures liquidity, preserves capital, but doesn't lock up funds for too long. It's that predictability over short horizons that makes them indispensable.
Gotcha. And, as we've touched on, another key thing, no regular interest payments.
Right. Unlike a CD or many bonds, no quarterly checks in the mail, so to speak.
You just get the full face value when it matures, kind of a set it and forget it deal until then.
Pretty much.
Next up, our sources consistently emphasize that T-bills are highly liquid. What does liquid mean in this context?
Good question. Liquid just means how easily and quickly you can turn that asset into cash without losing significant value.
So easy to sell if you need the money back early.
That's exactly right.
Mm-hmm.
A high degree of liquidity means if you buy a T-bill but suddenly need your capital before it matures.
Something unexpected comes up.
Yeah, you can typically sell it pretty easily in what's called the secondary market.
There's a market for used T-bills, essentially.
Huh, well, yes. A very robust, active market where T-bills are traded constantly. It ensures you're not stuck holding it until the official end date.
That flexibility must be a huge plus.
Oh, absolutely. Especially for big players managing huge sums. They need to react quickly sometimes.
Hmm.
It provides peace of mind that your capital isn't, locked away entirely.
Okay, makes sense. And finally, a really prominent use case, parking cash.
Mm-hmm.
Our sources say they serve as a safe haven, a place where financial pros can temporarily store large amounts of money when other markets, like stocks, feel too risky or volatile.
It's more than just a passive parking spot, though. It's really an active decision to safeguard capital.
How so?
Well, think about it. During market uncertainty, just holding cash, plain old cash in a bank account, means that money is losing purchasing power due to inflation, right?
Right, inflation eats away at it.
But T-bills offer a modest yet reliable return. So they help mitigate that erosion while still giving you that top-tier security and liquidity.
So it's a defensive move, but one that still earns something.
Exactly. It becomes a strategic tool, allows investors to be defensive, preserve their principal, and still get some yield, rather than just sitting entirely on the sidelines doing nothing. It's pragmatic capital management when risk looks high elsewhere.
Okay, so understanding these basics, the discount, the short terms, the liquidity, the safety, it really starts to paint a picture of why these are more than just simple IOUs, especially for sophisticated traders.
The strategic uses are key.
Our sources give some great insights here, and this is where understanding T-bills can really help you, the listener, interpret what's happening in the markets.
Yeah, connecting the dots.
One fundamental application is as a hedge.
A hedge, right?
Instead of letting, uninvested cash just sit there earning zero and losing value to inflation.
Which is a guaranteed loss in real terms.
Right. Professionals strategically put that capital into T-bills. They secure the funds against market swings and earn that small, guaranteed return.
It's like getting paid a little bit just to wait safely. This hedging function is critical, especially for big portfolios. Even moderate inflation adds up.
So T-bills help fight that erosion on cash you need to keep safe and accessible.
Exactly. They don't aim for growth like stocks, but they excel at capital preservation plus a little bit more. Think of it as the ultimate defensive line for a portion of your capital.
Okay, defense. What about offense? Or maybe just a different strategy. Another key use is pursuing a safe yield.
Safe yield, yes.
When the stock market looks shaky, maybe there's geopolitical tension, bad earnings news, recession fears.
You hear about a flight to quality or flight to safety.
That's the one. Investors rapidly move money out of riskier things like stocks and into the safety of T-bills.
And this flight to safety is a really powerful indicator of shifting investor sentiment. It shows a collective reevaluation of risk versus reward.
So when the potential gains from stocks don't seem worth the potential losses,
The predictable, low-risk nature of T-bills suddenly looks extremely attractive. People willingly accept a lower return for that certainty of getting their money back.
you see big money flows during those times.
Oh, absolutely. The capital flows into T-bills can be immense during periods of high market stress.
Wow. Okay, perhaps the most intriguing insight, especially for listeners trying to understand the economy, is how T-bills function as a powerful signal for interest rates.
Ah, yes. This is where they punch above their weight.
Their simplicity hides some profound economic importance. The yield on T-bills. maybe clarify what yield means here.
Sure, the yield is basically the effective annual return an investor gets from holding the T-bill to maturity. It reflects the interest rate earned, calculated from that discount price.
Okay, so that yield, you're saying it tells a lot about what the market expects for future interest rates.
A tremendous amount. It's a key pulse point.
So break that down. If we see T-bill yields rising, what does that signal?
Generally, rising T-bill yields can strongly suggest the market expects the Federal Reserve, the central bank, to either keep interest rates high or maybe even raise them further.
And why does that matter for other investments, like stocks?
Well, that expectation of higher rates puts pressure elsewhere. Higher rates usually make borrowing more expensive for companies, which can hurt profits.
Okay.
And at the same time, higher rates make safer investments, like T-bills themselves or other bonds, relatively more attractive compared to riskier stocks.
So money might move out of stocks and into bonds or T-bills.
That's often the effect. It's a subtle but incredibly powerful ripple effect that T-bill yields often flag early on.
It's like an early warning system.
In a way, yes. What's truly illuminating is how these short-term instruments give us an almost real-time read on market expectations about Fed policy and economic health.
So it's not just reflecting today, but predicting tomorrow.
It's reflecting the market's collective bet on tomorrow. Participants are constantly pricing in probabilities for future Fed actions, and those expectations show up immediately in T-bill yields.
Give me an example.
Okay, say the market thinks the Fed will keep fighting inflation aggressively. That means likely higher rates. That expectation pushes short-term T-bill yields up now.
So the T-bill yield becomes this critical forward-looking indicator.
Exactly. Sophisticated pros watch it daily. It helps them anticipate broader market moves. And watching the relationship between short-term T-bill yields and longer-term bond yields, that's the yield curve.
Ah, the yield curve. I've heard about that.
Right. If it gets inverted, meaning short-term yields like T-bills are higher than long-term bond yields, that has historically been a remarkably accurate warning sign for potential recessions.
Wow, so much information packed into those yields.
It really is a complex signal from a simple instrument.
Okay, so let's try and distill this all down. What's the bottom line for our listeners? Let's bring it all together for a clear takeaway.
Let's do it.
A T-bill, at its heart, is like a very secure, very short-term loan you make to the U.S. government.
Super safe. Short duration.
It's one of the safest places to store capital. It earns a modest return through that unique discount way of working.
No regular interest checks, just the lump sum difference at the end.
And maybe most powerfully, its yield gives sophisticated investors, and now you, critical clues about where interest rates might be heading and the overall health of the economy.
It's quite remarkable, isn't it, how something so straightforward serves these dual roles.
Yeah, it's both a safe harbor for individual cash
and this incredibly sensitive economic barometer for the pros. It really underscores its safety and how it reflects immediate market thinking about the Fed, show how even basic tools are woven deeply into the economy.
We've really unpacked T-bills today, haven't we? We looked at what they are, how they work with that elegant discount model,
The discount to face value part,
their liquidity, which is crucial,
being able to sell them easily.
and how savvy investors use them for safety, hedging inflation, seeking that secure yield during rocky times, and as that really potent economic signal.
It's a lot of power packed into a seemingly modest financial wrapper.
It really is.
And if we connect this back to the bigger picture, getting this understanding of something like T-bills, it genuinely demystifies a key part of the financial world.
Yeah, it helps make sense of the news.
It empowers you to interpret economic headlines with much more context. You can go beyond just, oh, rates went up, and start to grasp the underlying market dynamics. You now know one of the key instruments involved.
So here's a final thought to leave you with. The next time you hear news about interest rates changing or market uncertainty brewing.
Which seems to happen fairly often.
Right. Don't just hear the words. Think about the humble Treasury bill. Ask yourself, what is its yield telling us right now? What does the market actually seem to expect for the future?
Is that yield curve flattening, steepening, inverting?
Exactly. How might these subtle shifts influence everything from borrowing costs for businesses to, maybe even the returns on your own savings down the line?
It really goes to show.
It does. Even the simplest financial tools can hold a deep well of knowledge if you just take the time to dive in and understand their story.